South African Reserve Bank decided to put a halt on interest rate hikes this week. They've peaked at 8.25% after rates were hiked 10 consecutive times. The decision was made after inflation figures eased to 5.4% in June from 3 to 6.3% in May. But one economist, Dr Roelof Botha, is not convinced that increasing interest rates is the right thing to do in South Africa's economy. He joins us to discuss this further. Very good evening to you, Prof, and thank you very much for joining us. I mean, one of the arguments that have been made when it comes to South Africa's stance on interest rates is that it's been likened way too much with the United States, and South Africa's economy is a far cry from the world's biggest economy, and yet our central bank is as aggressive as they have been over the last year and a bit or so.
Yes, well spotted. It does seem as if there's a little bit of a knee-jerk reaction every time the US raises their rates. More or less we followed suit, and it's quite ridiculous because the United States has virtual full employment. If you consider also the phenomenon of voluntary unemployment, people on sabbatical, studies, etc., people looking after newborn babies, then the United States effectively has full employment, which we do not have, not even remotely. So it's just unbelievable to think that we're trying to follow the suit or their suit. The United States' real interest rate currently is close to zero. Our real interest rate is approaching 6%. That is now the prime overdraft rate minus the CPI. And the very important point I want to make here, if she's listening, Jill Marcus, please come back. Because when she was Governor Reserve, she clearly targeted. It was so obvious that she targeted a real interest rate. And she understood economics. She realized that on, I think, 2 occasions when the CPI went above the 6% top target range during her tenure, she didn't panic. She didn't raise the interest rates because she knew, she studied the matter, she knew this was temporary exchange rate weakness. You cannot fix that. You cannot fix that with high interest rates. So she was just patient, and lo and behold, CPI dropped to below 6% again, and we had a real interest rate in South Africa on average during her tenure of 3%. The economy also grew at almost 3% in real terms. Now we have approaching a 6% real interest rate, which is the one that was around with the current MPC prior to COVID, and we've had almost zero growth. So count one and one and find two, I suppose.
Yeah, so I mean, Prof, it's a difficult situation then, because you're saying that the data points that the SARB says they use are very volatile, the currency weakness and so on, and they're forever changing. So what approach would the SARB need to then take? Because in that meeting, when the Reserve Bank governor gave his speech on Thursday, he indicated that the hiking cycle is not over, but also that South Africa hasn't reached its inflation peak, which is interesting because a lot of other economies and emerging market economies are saying that they are nearing or have reached the peak.
Yes, I don't know what they put in his coffee prior to that media conference, because as myself and several other economists in South Africa have pointed out, it's fairly obvious that our CPI inflation rate has peaked. I mean, the producer price index has come down from a level of 18% in July last year when it peaked, same month as the CPI, down to just above 7%. That's a 60% drop. In any event, what I think the viewers, most of them appreciate, is that we do not have demand inflation in South Africa. And every economist that has had the guts to criticize the Reserve Bank, for some reason people are afraid of them. I don't know why, because it's 5 individuals, the MPC, and I can guarantee you they don't know everything about economics, because otherwise we would have had a lower interest rate in South Africa today. Our priorities should be growth and employment creation. But the reasons why the CPI has declined and has peaked already is the number one reason why the world has been battling with high inflation over the last couple of years is because of a 700% increase in global freight shipping rates. 700%. Now that has come down from, according to the Statista Freight Rate Index, from it was $1,200 for a 40-foot container median distance. It went in the space of 2 years, it went to 10,400. Now it's dropped back to 1,400. So that's number one reason. Second reason is the oil price. West Texas Intermediate has dropped by 40%, 40, in the last 12 months. And then, of course, the weaker dollar. There's a risk on sentiment coming back into the market because everybody expects the US rate hike cycle to have ended. So they're willing to buy emerging market bonds and stocks again with a stronger rand. That's the reason why inflation has dropped, not because of the Reserve Bank's high interest rates, despite the Reserve Bank's high interest rates.
Yeah. So, Prof, how do we then begin to deal with this for the consumer and businesses? Because the ripple effect is that the middle income earner, which contributes the most to the economy, has suffered with higher debt repayments, and the list goes on. And then big employers like mining companies are drowning in higher loan repayments to the banks. And so their ability to absorb more people for jobs and so is diminished. How do you then approach the situation with the ripple effects that we are already starting to see being lived in the real economy?
Well, we are at the mercy of 5 individuals who comprise the Monetary Policy Committee. And I have suggested to government through various forums and my columns which I write and my presentations that they should seriously consider changing the composition of the Monetary Policy Committee to include 3 people from the Reserve Bank, 2 from National Treasury, preferably the DG and the Chief Economist, 2 from Department of Trade, Industry and Competition, preferably the DG and Chief Economist, and 3 private sector economists who can be drawn from a pool of people with at least 25 years experience practicing economics and at least a master's, preferably a doctor's in economics. Then you have 10 members. And I can almost guarantee the viewers that if this were the case, then our prime rate would have been probably 200 basis points lower than it is today. The Reserve Bank has an obsession with the target range, which is flexible. It's supposed to be flexible. They could have just lifted the target range, then we didn't need these interest rates, but also with inflation expectations. And 2 other economists of note, Prof. Graham Barr from UCT and Prof. Brian Cantor from Investec, have also pointed out this fallacy in their theory. I just want to advise the viewers that these inflation expectations, which are being conducted by an economic research agency, are based on surveys amongst decision makers, as they call it in business, finance, and labor. The sample size is extremely small. I don't think it qualifies as a survey that you should actually base economic policy on, which affects 60 million people in this country, directly or indirectly. But there's an absence of any kind of verification that these opinions are objective and based on authoritative economic research and knowledge. So there are so many flaws in the monetary policy of the South African Reserve Bank that I really believe that this government of ours should escalate this issue and listen to my advice and the advice of several other private sector economists and get the MPC to stop fooling around with some little models.
Thank you very much for those insights. Very sobering thoughts there that you've shared with us, Prof. Roelof Botha, there, saying that there needs to be a relook at the composition of the SARB so that it's representative of the real economy and the lived experience of people in South Africa. 60 million people, he argues, are facing decisions that are made by 5 individuals sitting at the central bank. Thank you very much for your time this evening.